Okay, everyone, welcome back. Thank you as always for listening. And today, watching, we have another Hot Topics episode where I'm joined by Lauren Hunt from Daybreak Wealth out of Illinois. Lauren, how you doing?
Good. How are you, Andy?
Good. So it's not Daybreak Wealth, right? It's Daybreak Wealth.
Correct.
Yes,
Daybreak, not Daybake. No.
Yes. And for those who don't know, Lauren was on the show, I believe, some point last year on one of the Talk with Other Planner episodes. I'll be sure to link to that and go check that out for those who are interested and want to learn more about Lauren and her firm. But today will be a Hot Topics where we will casually chat back and forth about a handful of things that are current events or on the minds of people we talk with, be it consumers or clients or other advisors even, and just some other stuff we thought would be of interest to people. So how's that sound, Lauren?
Sounds great. Thanks for having me back. Should be a really interesting conversation.
Definitely. These hot topic ones have gotten really good, have been really well received by people. So I'd like to keep this rolling, and I think you'll be a great person to have on to chat about this stuff.
Yeah.
Before we do, though, I have a story for you.
All right, let's hear it.
A customer called the First National Bank of the South, and the automated voice answers, "Hello, how can I assist you today?" The person says, "Withdrawal." The automated voice then says, "How do y'all reckon I can help y'all today?" Get it? Withdrawal. Man. Right?
Where do you find these? Do you Google them beforehand, or do you just have a steady stream of awesome jokes?
I'm not creative enough to be able to come up with these. My go-to source is there's a spot on Instagram, an account called Dad Says Jokes. That's usually my go-to. Otherwise, people have taken upon themselves to send me jokes. This one was actually someone sent me on Facebook, but nice. I sort of got that rap now, for better or worse, as being the corny dad joke guy. All right, so let's talk about some hot topics. The first of which is recently the Social Security Annual Trustees report came out, where it just recaps the prior year's operations of the system, current balances, inflows, outflows, whatever, and all the various assumptions that go into, they have to make both, I think it's a 10-year and then like a 75-year projection about the sustainability and health of the system. You have any initial thoughts? We can dig into some of the specifics here, but
I would say my initial thought is that not much in the report has changed from previous years, that it's not fully funded for an extended period of time, and so we'll likely need to make some changes in the system, but it's not clear yet what those are, was probably my big takeaway.
Exactly. It's more or less the same story that's been in the last few annual reports that says the trust fund is expected to deplete. Now, the difference this year is it's expected to deplete 1 year faster than projected last year, specifically the part of the system that pays benefits to retirees as opposed to disability. That's its own sort of subsystem. But the system that pays benefits to retirees was, as of last year, expected to have the trust fund deplete in 2034. Now it's expected to deplete in 2033. One noteworthy difference driving that is that the, what was it called? The Social Security Fairness Act or something that went into place earlier this year that repealed the, what's known as WEP and GPO, without getting into specifics, but was basically reduced payments or eliminated payments for people who had like public sector pensions. So got rid of those. And that, all else equal, means more money coming out of the system, hence further straining an already strained system. Now, we won't get into whether or not that's fair or not, the whole repeal of those things, but that was the main driver behind the change results. Now, what does that even mean? Like, people commonly say, or wrongfully say, the system's going to run out, right? Or the system's going bankrupt, or my benefit's going to go away. I mean, how should people interpret and understand the findings of saying the trust fund is likely to deplete in whatever it is, 8 years from now?
So, if I remember reading correctly, they said that it was fully funded through 34 and then partially funded after in some of the buckets. So when I read things like that, what I read is that the benefits likely cannot continue as they are. And what might they change? Like, how should people think about it? I think we can only plan for the rules as they are today, and continue to make decisions based on what the rules are today. But if I were a younger person starting my journey, right, into retirement planning I might consider that benefits would be lower. I might have to work longer, that they may be means tested, right? That I might consider there be some different delivery mechanism for the benefits. If I were currently receiving benefits, I don't know that I would change my thinking about this system at this time. I mean, do you feel differently? Like, would you tell someone currently receiving benefits, you could run your plan, assuming there is no benefit, a half benefit, and just see what it does. But I don't think there's anything for consumers to do. Do you disagree?
Yeah, no, same page. So the projection, now this is projecting out over 75 years, so a lot can and will change, but the projection is if nothing is changed about the system from where it stands today, the trust fund is expected to deplete in 8-9 years, whatever it is. At that point, if that happens, there won't be enough money coming into the system day to day to fully fund the payments it's expected to make out. Specifically, everyone across the board, both people who are 18 and just started working, their eventual benefits, and people currently on benefits would need to see a reduction of I think it was 23% or something. That's not going to happen. So my view, my opinion, is that anyone, like you said, currently getting benefits or close enough in age to getting benefits, and where you want to draw that line, I don't know, 50 plus, 55 plus, 60 plus. I can't see a scenario where their benefits actually get top line reduced. Yeah. I think me, late 40s, and people younger than me definitely will have benefits reduced in some form or fashion. And this has happened before. This isn't the first time the system was strained. And just as a actual sort of data point of what can happen to help improve the system, originally the full retirement age was 65 for everyone, period. And I think it was the 80s, the system was strained and changes went into place to help bolster it. One of the changes, which was in effect a reduction of benefits in a roundabout way, was to increase the full retirement age from 65 to 67 over this phase-in period. And it didn't happen overnight. It wasn't like if you were 64 at the time, it's not like your full retirement age was changed to 67 overnight. It took decades for this to phase into people, and we're just finally seeing now, people's full retirement age is finally getting phased up to 67. So I think something like that will happen. Mm-hmm. There's lots of small little fixes to tweak and make the system better, a number of which can be done in combination. It's not like there needs to be some massive sweeping change where everyone pays in substantially more, everyone gets out substantially less. There could be a series of small tweaks that on the surface, none of them might feel too impactful, but they can add up to make a meaningful difference, such as, again, increasing the full retirement age from 67 to whatever, 68, 69, 70, I don't know, amongst other things, like changing the contribution rate that people pay in to make that slightly higher. And there's a whole bunch of things, but
they could change the delayed benefit rates. I agree, there's a lot of little things that day-to-day people might not notice are changing that could have a big impact.
Yeah, but I'm with you. If you're 55-ish plus, I see no reason to think your benefit will actually be reduced. If you're younger than that, definitely 40 plus, I'm feeling like that's where I draw the line, where, there's going to be some reduction. 40 to 60 is that's the range where I'm not sure. This report says nothing dramatically new. It shouldn't be a surprise. And changes will happen. They'll likely happen on the 11th hour, because this is such a hot potato that no one wants to put their political willpower and goodwill behind reducing benefits, or having people pay more in. Right. Which everything is going to be some combination of that. All changes are some combination of those two things. So, but changes will need to happen. It's just going to be, 10 years or whatever, 7-8 years from now, as opposed to, next year, or such is my guess.
I do agree that we will kick the can down the road, so to speak, until we absolutely have to make a decision, just because it is such a hot topic and a tough conversation, right?
Hot topic, I like what you said there. Okay. Right.
No pun intended.
Sorry. Right, yeah. So I don't know. I mean, there's nothing else I feel the need to say about this. It's the same as it's been the last few years, but anything else you want to add here?
I guess I would ask, I don't regularly get asked, and I am curious if your clients are asking you to run the plan in the 6 or 7 different ways you could run it to provide comfort. I feel like most people that I'm working with that are already in retirement are willing to continue planning for the benefit they have versus where, like, in the past when I've worked with younger clients, I would be getting requests for, can you run it with no benefit or a half a benefit? Like, day to day, how are you seeing it implemented in your practice? Like, are clients asking for different scenarios?
Yeah, great question. They're not, and partly because the thoughts I expressed to them or what I said here, like, I really see no reason to have to do that. And because we only work with folks who are typically 55 and older,
right,
they fall in that range where I'm convinced, like, you're not having a reduction. More of it might be tax. I think that's another minor lever that's likely to happen, but the benefit itself won't get reduced. Now, if I worked with people who are 40 or younger, 100%, I would be making some sort of assumption, just, a top line 20, 30% cut to benefits just as a starting point. But otherwise, no, I haven't had anyone really push me to do that. And maybe because they, for right or wrong, they believe me when I say, I don't think you have to worry about this. So, no.
That's what's happening in my practice, too.
Okay. All right. Next, this is probably the hottest of hot topics. The One Big Beautiful Bill Act. Now, I want to preface this by saying we're recording this on July 2nd, 2025. This has been bounced around a lot in the last few weeks, even the last 48 hours. So we're just going to share now what we know, what we think we know about where this currently stands. It still needs to, as of today, as of recording right now, the Senate signed off on their version. It needs to go back to the House for them to sign off. The House's previous version was slightly different than what the Senate agreed on now, so expect there'll be some more changes. But potentially, this could be agreed upon and signed into law by July 4th, which was the self-imposed deadline that Trump gave Congress to have this on his desk by. So by the time you all hear this, it's going to come out tomorrow, July 3rd. Like, this could have changed already and or have been signed into law. But we wanted to just share some commentary about what sort of appears like, what changes are we pretty confident in saying these changes are probably going to stick, or at least some minor derivation of them, just to get it on the radar of you all listening. But again, this could be different by the time this comes out, and when the final bill is finally signed into law, I'll be sure to do another episode to talk about what actually now is in law. I don't know, how do you want to start this? Do you have any initial thoughts or comments, Lauren, about this?
I think the biggest takeaway for most people is that it looks like we're going to carry forward the tax cut provisions into the future, right? And so the tax brackets that we've been working with historically, I feel like I've had a lot of conversations with clients recently about them potentially sunsetting at the end of next year. And if this passes, and it looks like it's in both versions, that those will be continued. And so we can kind of continue planning without the expectations that tax brackets are going to jump. To me, that's the biggest, most impactful piece of the big beautiful bill. But what do you think? Like, what was your biggest takeaway?
Yeah, definitely that. As you know, we've all been sort of in a holding pattern, knowing that the Tax Cuts and Jobs Act and the current generationally low federal tax rates that we have as a result were due to automatically revert or sunset at the end of 2025, at which point, starting in 26, they'd flip back to slightly higher rates that we had pre-Tax Cuts and Jobs Act. Now, going up into the election last year, there was a suspicion that, if Trump won, then expect that the Tax Cuts and Jobs Act would largely stick around and get extended. If Trump did not win, then the expectation was, yes, we would assume these tax rates would actually sunset and go back up in 2026. So after the election, we sort of had a little more clarity, or at least a little more reasonable assumption that, okay, we now think these rates will stick around for a while. Now that the House version of the One Big Beautiful Bill Act came out in May, and the Senate just recently revised its version, and they're largely in agreement, I think now it's really safe to say that the final version of this bill that will be signed shortly, presumably, will extend and make permanent the current tax rates we have under the Tax Cuts and Jobs Act. Now, I say make permanent with a grain of salt, because the tax legislation is written in pencil, can always be changed and will be changed by future balances of power in Congress. But for now, I think the we all sort of the last few years felt this rush, like, okay, we know we have at least through 2025 to do like large Roth conversions or other large tax planning things before rates go up. That pressure's definitely been backed off substantially, if not completely, for now.
Yep, and that's the biggest change. Like, no need to necessarily plan for accelerating income before 2026, whether it be through Roth conversions or, different accelerated income strategies.
Yeah.
I do think I also saw that they were extending the estate tax, the much, much higher estate tax limitations. So a lot of what had been done before is more like status quo now, is my big takeaway.
Yeah,
and
exactly.
For people working with planners, right? Those are things that we're looking at. Sorry, go ahead.
Yeah, like knowing that, again, part of the Tax Cuts and Jobs Act was, if nothing changed, at the end of this year, the federal estate tax, gift and estate limit, lifetime exemption would have gotten cut in half. So there's like more impetus again to like people where these estate sizes really matter, to get money out of your name legally now while you can. That pressure has also been removed for the foreseeable future. I'll just mention some specific bullets of things I thought would be of relevance to many or most people.
Sure.
Typical U.S. taxpayer. These are subject to change again, and by the time you hear this, it could be different than what I'm saying now. But it seems like these things, or some slight tweaks of these, are likely to make it into the final bill. So not only the current low tax rate sticking around permanently, but the higher standard deductions we have under Tax Cuts and Jobs Act also sticking around. Those would have got cut in half if nothing changed. On top of that, it looks like there's an additional up to $6,000 extra deduction for people 65 or older on top of the existing standard deductions. Even if you itemize or take standard deduction, my reading is this is just an additional $6,000 per person for people 65 or older. Now, two caveats. There is a gross income phase out for single people, 75 grand of gross income. This starts to phase out. For married joint, it's 150 grand of gross income. And this would start this year, 2025, which is good for people, but difficult for planners, because now we're going to have to revise all of our projections and estimates and whatever.
Yeah.
But it looks like this is going to stick, and this extra $6 grand would be through 2028, at which point it would stop and goes back to just like normal standard deduction. Like you mentioned, the estate tax exemption would actually be $15 million starting next year, as opposed to under Tax Cuts and Jobs Act, it'd be like 14 and change after inflation, but it would start at 15 per person. One of the things I like, the AMT, alternative minimum tax, was hugely annoying pre-Tax Cuts and Jobs Act and captured a lot of people. Under Tax Cuts and Jobs Act, it basically made a much larger exemption to this. Long story short, but vast majority of people aren't subject to this anymore. It looks like higher exemptions will be sticking around, such that much less people need to worry about AMT going forward. Super hot topic, especially in states with high income or property taxes, the SALT caps, state and local tax. Under Tax Cuts and Jobs Act was capped at $10,000 total for people. So meaning combined between property tax and state income tax, you could only deduct up to $10,000, which means most people couldn't take that itemized deduction, especially when the standard deduction has become so large. Under current Senate version, to be determined the final version that ends up sticking, starting this year, the SALT cap will be increased to $40,000 from $10,000 through 2029. But there's going to be income phase outs. If your income's over $500,000, you start to drop down from 40 back down to $10,000. So potentially good news for folks that have high property taxes or high state income taxes for the next few years if this sticks.
Did it have any limitations on second properties, or did it have to all be primary residences? I didn't see that.
I didn't dig that deeply. I don't think so. I think like now property tax is property tax. If it's personal property and not like a rental, whether it's a primary home or a vacation home, like the property tax is all eligible, again, subject to the cap. I don't think they were changing that. So if you do have two homes, for example, I believe the property tax on both would be able to contribute toward this potential $40,000 cap for the next few years. Some new things which are floated around, which looks like they might stick now, is no income tax on tips, tip income, not Treasury and Treasury, whatever.
Inflation protection.
Yeah, like tips, like if you're a waiter and people, pay you some tips. It looks like up to 25 grand of tip income could be excluded from income tax, not excluded from Social Security tax, but excluded from income tax at least. And I think there's income phase out on that as well if your income's over a certain level.
Yep.
And no tax on overtime, no income tax. It would still be subject to, Social Security and Medicare tax, but only up to $12,500 of overtime income per person could be excludable. And again, I think there were income limits where this would start to phase out. And one final thing I wanted to mention, which might impact a lot of people, is the deduction on interest on car loans. Specifically, the car needs to have been final assembly in the U.S., not abroad. There's income phase-outs as well, and this will be 2025 through 2028. And I don't know if this will be an itemized deduction or this would be an additional, just like separate deduction above and beyond itemized or standard deductions. I didn't think to read into that. So I don't know. That's the stuff I thought would be of relevance and might come into play for some folks. Again, this is changing rapidly, so who knows? This could be very different in a few days.
So one of the tax planning strategies that I have been working with some clients on is clumping charitable deductions, right, so basically making a larger deduction, whether that be into a donor advised fund or a larger donation at one time, so that they could take a larger tax deduction rather than doing smaller donations over a lot of years so that they didn't get past that standard deduction. Yeah. And I feel like a lot of the stuff you just summarized, again, supports this idea of trying to clump deductions to get past those higher standard deduction rates and clump how we're taking them. Is that the guidance you're giving your clients as well? Do you see different planning opportunities the way that the deductions are listed in the current version of the bill?
It depends. So yes, I've been doing the same as you with clustering deductions instead of doing like $5,000, donation. Instead of doing like a $5,000 donation every year, do like a $25,000 donation every 5 years, so you can itemize in that year. Now, one thing I forgot to mention is in the Senate version of the One Big Beautiful Bill Act, it looks like there's an additional charitable deduction people can take even if you don't itemize of $1,000 per person, I think, $2,000 per couple, and there's some limitations, I think, phase outs to that. So that could change analysis a little bit, even if you still do clump together, maybe do at least that, $1,000 donation or whatever to take advantage of that each year. But also now, if this SALT cap is indeed raised to $40,000, a lot more people will be itemizing going forward. Yeah, so then they could itemize their charitable donation. So that would, so that would mean you don't have to clump together multiple years in that case. It's going to be tricky because a lot of these things have phase out limits and whatever. So like it's going to make tax planning much more involved for the next handful of years, starting this year, because a lot of these changes are going to affect this year if this makes it into law. So it's a mess. It's a mess, I think.
Well, and I think one of the other things I saw that might make the tax planning more difficult was, did I see they were bringing back the cliffs on the Medicare the premiums for the ACA?
Great point. Yeah. So, right. What's as important as what's in the bill is what's not in the bill. And what's not in the bill is extensions to the current enhanced Affordable Care Act premium credit. Yeah. So as it's structured now under, I think it was like the America Rescue Plan or something that made enhanced ACA credits, that did two things, and it did those two things up through the end of 2025. It got rid of the hard cliff where if your income exceeded 4 times the federal poverty level, you're not eligible for any credits, like full stop. That cliff was removed, so you can still have more than 4 times federal poverty level, and the higher income, you slowly get phased out of credits. And the other change was, income threshold aside, the amount of credits you can get for any given amount of income you have were made larger under the temporary rules. So there's no mention of extending those enhanced ACA rules, which means after this year, the hard cliff comes back. If your income is more than 4 times federal poverty, you're not getting any ACA credits. Even if your income is below that, the amount of credits you'll get will be reduced from what they've been over the last few years. So that's a big planning opportunity, or now lack thereof, for some people. If you're still eligible in 2025, this might be the last year to take advantage of getting credits if you can, knowing next year you might not be able to.
And yeah, so I think that that'll be interesting. I do think as they bring in back those harder cliffs, as they roll out bills, it makes planning harder because you can't be wrong by $1, right?
Correct. Yeah. So
I think that will be interesting to see how that execution-wise plays out for people as they move forward.
Yeah, it's going to be a wild second half of the year, no doubt, for tax planners. All right, there's lots of other stuff in the bill above and beyond just personal income tax stuff. We're not going to even get into those, partly because it's, I don't know. There's lots of different other, incentives and credits for businesses and energy initiatives and whatever, but I tried, for today's sake, just try to keep it to relatively plain vanilla personal income tax stuff that are likely to impact folks, most folks at least. Anything else about the bigness or beautifulness of this bill you want to touch on, or should we?
I guess we could move on. I guess I would go back to what you said earlier, that it's probably written in pencil and it may get executed, and I think it's likely we would see changes down the road just from a sustainability standpoint. But you can only plan for what you got. So when it's enacted, that's what you do, and we change again when they start over in the new pencil.
That's exactly it, yeah. So, expect if this does go into law, we're going to have it for a few years at least, and then as there's midterm elections, the next presidential election, whatever, this stuff is all subject to change and will change, just a matter of when, not if, this stuff is going to be tweaked around again. Yeah. But while we have it, exactly, we know what it is. For as long as we have it, plan with it, deal with it, make the most of it.
And adjust where you can.
Okay. That's it. All right, this one has come up recently with me, with some clients, and I've seen questions in the Facebook group. Whether or not to get a loan to buy a new car. And I guess a spin on this would be whether or not to get a loan to buy a house, or if you have an existing mortgage, do you pay it off or not? There's lots of ways we can go with this, but I guess what are your thoughts if someone asks you either of those questions?
So I get the mortgage question more frequently than the car loan question. And what I generally tell my clients is, for me, it's a matter of what rate do you have? So I have some clients with a 2.35% mortgage rate, and I think it's a reasonable assumption that long-term investing, you probably or might be able to do better than 2.35%. So pulling the money out necessarily doesn't make sense to me from just a rate and expected return standpoint. Right. It starts to get a little bit more difficult at, the 4 or 5 or the people with 7% rates. Then sometimes it does make sense from my perspective to consider taking the funds and not either taking on a loan or paying off the loan. But I think the other piece to it is just people's emotional comfort with it. And you and I both work with a lot of people who are either in retirement or entering retirement. And I find that there's a lot of people who just emotionally don't want to carry debt into retirement. It makes them feel more secure. And I think that factor matters as much as the mathematical play of did I do better or not do better in the end. So I feel like I end up having both of those conversations with my clients, and some of them with the super low rates end up maybe saying, not my favorite emotional thing, but I get it. Yeah. But anyone who's getting some of the higher rates we're seeing now, I'm seeing more people kind of choose to pull from the portfolio and not take on the loan. Do you say anything different? How else do you explain it?
No, that's exactly it. Start objectively and look at, okay, what's the rate on the loan you have or the loan you're considering getting, compare that versus what else could you do with that money instead, especially now when cash equivalents like money market mutual funds or high yield savings accounts or individual treasury bills are paying 4%, give or take. If you have a mortgage that's like my mortgage, we refinanced to a 15-year 13 years ago at 2 5/8, which is what, 2.625 or something. There's only like 40 grand left on it, and it's just the cash we have sitting in Treasury bills is getting 4% still, and high yield money market's 4%. It's like, why would we take that, in effect, I don't say guarantee because it can change, but we know we're getting a relatively low, almost risk-free rate of 4% on our cash. Why give that up to trim down a loan where we're only costing us 2.625%? Like, it doesn't make sense.
Exactly.
But I 100% understand and agree that so much about personal finance is more personal than it is finance, especially for retirees. If they stop working and it's important to them, they sleep better simply not having debt. Even if pure dollars and cents, it says it's fine to carry that debt.
Yep.
I'm not going to tell them that's a bad idea, because I get it, right? I want people to sleep well at night is ultimately, I think, the biggest goal we have, right? Now we focus on the numbers behind it, but, which is interesting now that I say that, because I'm inclined to pay off our mortgage. We can. It's like $40,000 at this point, and part of me just wants it gone.
Because it's annoying.
Because it's annoying, right?
Yep.
Yeah, and it would feel really nice at, not even 50 years old to have a fully paid off house. But I'm like, that doesn't make sense. And my wife is more sort of pragmatic and numbers driven in decision making than I am here. It's like, no, absolutely not. We're not paying that mortgage off. It's like, yeah, I get it. Okay. So we still have the mortgage, but yeah, where it gets a little more difficult, I had a client who needed to buy a new car, and the rates were either like 6.99% or 3.99. I was like, 6.99, no. That's high. 3.99, it's like a push, because your cash is getting roughly 4.
Yep.
And it also comes down to like what's your comfort level with loans. Some people don't like the principle of paying for a car in cash just because they don't want to use up that much cash. So answer is slightly different for everyone, but it should start with the dollars and cents and pure mathematics of it, also considering the subjective qualitative aspect of it.
Yeah, and I guess I would add, not everybody can make the full payment out of their portfolio. And so I always try and remind people it's not always an all or nothing decision either, right? If you are stuck with that higher rate and maybe don't like it for the mathematical reasons we just said, like, can you take a bigger down payment or a bigger piece to just reduce the amount that you owe interest on? So like, look at the middle ground options too, for just practical planning purposes for people.
That's a good point. It doesn't need to be all
sort
or none.
of stuck. Yeah.
Yeah.
Like, or just really can't get comfortable with pulling, as cars get more and more expensive, 70 grand out of their portfolio. Like, they just emotionally bothers them that way, like to pull that much out at one point.
Yeah.
That maybe there is that middle ground to consider from both a practical and an emotional standpoint.
Definitely. And I guess a lot of planning is that, right? It's being aware of the pros and the cons, and finding the happy medium of what are you getting for this, what are you giving up for that, and just hitting that spot where everyone's comfortable making an informed decision about whatever course of action we're doing.
Yep.
Okay. Here's one I had a conversation on last week. So I was at a conference and sitting at a table with someone I hadn't met yet, and somehow we got on the topic of annuities, and this person fundamentally opposed to annuities. And I just want to step back and say that I think annuities are a very polarizing topic. Yep. There's a lot of misinformation about them amongst consumers and even within the industry. Like, many people who don't have insurance licenses are unduly biased against annuities and uninformed about what they can be. Now, to be fair, I know a lot of annuities are oversold. They're sold more than they're bought. So sort of rightfully, there's a bad rap and bad perception of it, but there are cases where it makes sense. Yep. Namely, people want or need lifetime guaranteed income. Yep. Or there's some annuities you can use as like a CD equivalent. But anyway, so the conversation came up, and I don't sell annuities. I'm not like a staunch supporter of them. I think they're a tool, and where they make sense, they make sense. So I try to be objective about it. This person just flat out like, no, I hate annuities. They never make sense. I was like, okay. So we kind of got into it a little bit. But he said, and this is something I wanted to throw out there and get your point of view.
Sure.
He was like, well, why can't you just buy a 30-year Treasury bond and get the coupons every year for 30 years? That's in effect guaranteed. My view is like, it's not lifetime guaranteed, and there's other pros and cons. But so I don't know. I guess, what's your thoughts on that? Someone who's in or near retirement, they want guaranteed lifetime income. or something as close to it as possible, do you feel buying like a single 30-year U.S. Treasury is a close enough replacement or equivalent for an annuity?
So I guess I'm going to say I generally agree with you that annuities are a tool. Like, it's definitely not my general go-to for the client that I typically work with. It's not necessarily the first fit that I personally look at, but I also think that they can be the right fit for certain people, certain situations. One of the ones you mentioned is needs guaranteed lifetime income. Maybe people who get really, really nervous about investing in the market, but need some growth in the portfolio. Maybe for them, it makes sense to be paying for that guarantee on some level, right? To get the money into the market. So I definitely think that there's places that they fit into people's lives. I don't know that I think that those are direct alternatives. I think that would be a choice for people. But my gut is to agree with you, right? Like, it is not lifetime guaranteed. I think rates can change. Like, you have to manage that, where I think a lot of people buying annuities, one of the things that they like about it is it's a little bit more set it and forget it, right? Like, I put this money in, I've paid for it, and it's kind of like the box is checked. And I don't know that I think that happens with buying the Treasury. A little bit, it's just not quite the same. So no, I don't think it's a direct alternative. Do I think it could be a solution for someone who really hated alternatives? Sure. Like, I don't know. They're not the same product in any way, in my opinion.
Correct. Yeah. The crux of my, I don't want to say argument, because it almost sounds combative, but it almost did come down to an argument with this guy, is you don't buy, well, annuities can be lots of things. There's like infinite different forms and types of annuities,
which makes it here, right?
Yes. Yeah. I'm talking just in the context of someone in or near retirement wants or needs additional guaranteed lifetime income, a la Social Security or traditional pension. Monthly payments that'll last as long as you do. They stop when you stop, or maybe there's some spousal, continuation, but it's that. And so, generally speaking, and this is what I tell clients even, a well-invested portfolio is likely to financially do you better than buying an annuity and the income you're going to get from it. But notice I said likely. It's not guaranteed. Like, you buy an annuity, specifically the kind I'm referring to in this context of this discussion, you're in effect buying a pension. You hand over a lump sum of money to an insurance company. In return, you get an IOU from them saying, I will give you X amount of dollars every month for the rest of your life. There's simplicity, there's guarantee, there's certainty, there's a longevity protection. Even if you live to 110, good for you, you still get these payments. There's a cost to that, and there should be. And that's what this guy was missing. Like, it's the guarantee you're paying for. Is that worth it? No, not for everyone. For some people, yes, who want or need the peace of mind, who want the set it and forget it-ness. They don't have to worry when they're 90 about managing their portfolio or having to now reinvest their bond that just matured. So I'm not saying this as a shill for annuities, but I do see certain people and circumstances where 100% this is the right solution, and for anyone to just poo-poo it outright and be like, no, never, like, I will never, like, that's just a disservice to everyone. So
I agree. I do think all the tools exist, right? And you should consider what fits each individual circumstance. And we see this one the same way. Like, they're just not quite the same product. And I generally say the same things to clients, right? You're likely to do better with a managed portfolio. The data tends to suggest over the long term you would end up better off. And that doesn't mean that everyone wants to ride out the volatility of the market. It doesn't mean that everyone isn't afraid of living longer, or people who are afraid of the Social Security going away. Like, there's lots of reasons for people to consider these products. I think when you're considering the product, it's important to read the details, understand what you're buying, and make sure that you're not being sold something that's different than your need. That would be my push on the annuities.
Exactly,
to buy the annuity that actually matches the need you're trying to fit.
And that's a huge part of it. What exactly are you trying to solve with it? Make sure you get something that's as clean and efficient and as cost effective at meeting that need. And I don't want to make this sound like I don't lead with annuities with clients. I know some advisors do. Like their standard approach is everyone gets an annuity of a certain amount, and then we invest on top of that. Like I don't lead with it. I try to be as agnostic as possible. If and when I think it makes sense, based on conversations with the client, based on the objective circumstances of how much money they have versus what they expect their income needs to be and want. There definitely are times where this is a fit. It's definitely not all or none. So anyway, but there's a lot of complexity in these. I'm generally not on board with people using annuities as investment alternatives or replacements to accumulate money. Definitely not. For guaranteed lifetime income, yes. And other certain limited circumstances like CD equivalents for a few years, an annuity could be a good solution to that. Everything else, it's overly complicated, not the most cost effective generally, and the vast majority of people will never fully understand the annuity they have outside of just, again, a super plain vanilla like lifetime pension type annuity. So
I agree with that. I think a lot of people, I think it's hard to understand them even if you have some education about them. All of the products, even if they're called the same, are very different. So I wouldn't say that that's necessarily a knock against the consumer. I just think they're very difficult to understand.
Definitely. Super complex. And I don't think it's intentional. It's not like some underhanded, nefarious scheme from insurance companies. It's just they are complicated products with lots of features and riders and bells and whistles. And the more functionality you have, the more difficult it's going to be. And there's going to be a 2, 3, 4, 5 dozen page formal contract that comes with it that details in fine print legalese how exactly this works, what the rights are, what the contractual obligations are, et cetera, et cetera. So it's complicated. That shouldn't stop people from considering it if it is the best use for the best product to meet their need. But it's an interesting animal.
Yeah. Well, while we're talking about stuff that fits, you and I had a conversation back and forth about like living trusts and whether they fit into people's portfolios. I tend to be a proponent for a lot of people for trusts. I think that they could, obviously I'm not an estate attorney, so I'll preface that with that. And you should always ask your attorney whether it's a fit. But I see a lot of advantages for the types of clients that I work with: privacy, ease of moving assets, ease of transfer of assets for unexpected. In Illinois, our state estate tax is lower than the federal, so there's some place there for people who are above the Illinois estate tax but below the federal. So I see a lot of implications or practical uses for them for my client base. I see the biggest kind of hiccups being that they're a pain to set up, that you do actually have to like retitle all the assets into the trust. Sometimes I see people go through the effort of setting it up and then not actually funding them. But overall, I tend to generally recommend them, although I hear, and by recommend I mean suggest people ask the attorney if it's a fit, right? Yeah. But that is one of the things that I do regularly see come up in my practice. Are you also seeing that come up, and do you have a similar take, or do you kind of come out less frequently a proponent?
The latter. I'm still trying to get as informed and educated as I can about the use cases and where plain vanilla living / revocable trust makes sense. And it's confusing because I'm not a lawyer, like you. Yeah. I've talked to 2 well-established, experienced New Jersey estate planning attorneys who do wills, powers of attorneys, trusts, stuff like that. One says 100% everyone should get one, because why not? The other one, no, absolutely not. In New Jersey, probate's relatively quick and easy. I guess depends on your county and whatever, but relatively inexpensive, relatively straightforward. And so he'll do it if people ask, but he definitely doesn't push living trust. Oh, now what? These are 2 experts and they're giving complete opposite answers. What am I supposed to do here in the middle? I think it depends on state for a few reasons, like California, where the cost of assets going through probate is higher than in most other states. Having your non-qualified assets, so like your real estate, your bank accounts, your brokerage accounts owned by a trust, if nothing else, will help avoid those assets being subject to the probate administrative expenses. The privacy thing for people who care. Like when you die, if your stuff goes through your will in the probate process, that is in theory all public record that anyone could find out if they were to go dig to see what you owned and how much and whatever. So they do give an element of privacy because everything that is owned by the trust and passes through the trust to your heirs is private record. One thing in the last year that impacted my mom that's since opened my eyes a little more to, oh yeah, this trust clearly makes sense here, is owning property out of state, or if you own properties in multiple states, or depending where your property is relative to where your executor or executrix is. In my mom's case, she used to live in New Jersey, retired to Arizona a few years ago. She owns a condo. I'm her eventual executor. And the condo realized that if she passes, like, I need to fly to Arizona to start the probate process and do whatever's involved in, like, getting control of the house as the executor to make decisions for the house about selling it or what have you. Whereas if it's owned in a trust, like where I'm the trustee, like, it's seamless. Or so it's explained to me by the lawyer who did the trust. You know, she dies, I immediately, well, I guess upon proving her death, I immediately step in as the trustee. The trust already owns the house. So, like, I just step in and boom, like, it's seamless in that regard. So assuming that's all accurate, that has really opened my eyes to more cases where trust makes sense for people, living trust makes sense for people. I'm less convinced if your life is all based in the state in which your kids or heirs or executor live, and there's nothing much complicated going on about you, and the only thing that's not in a qualified account that already passes outside of probate, you know, like IRAs, 401ks, life insurance, doesn't go through probate as it is, will be real estate, bank accounts, brokerage accounts, and just personal effects. So I don't know. I want to be educated more, and I get that different states definitely have different different reasons and motivations. I almost want to get convinced, like, yes, I want to get on board with, like, telling everyone to get trust, but I'm not there yet.
Well, and I wonder, like, so definitely the two-state, because it can be pulled into probate, like, for exactly what you said. But I wonder if even for the executor, if you have to continue paying house, like local taxes or anything while you're trying to sell the house and manage the estate as the executor, if the trust makes it easier to use the funds that are there to do that without having to front it out of your own pocket, right? Like,
I think so. Yeah.
So I think that's the other advantage. Obviously, minor children guardianship comes up for people who have kids under 18. I do think trusts give people more ability to have control and say over, like, little things, which sometimes I see come up. But kind of like we were saying about the annuities, I don't think that any tool is the perfect solution for every person. But I see more and more places where it makes sense than it doesn't, but that might be the nature of the clients that I'm working with on a day-to-day basis too.
Yeah, agreed.
Right, that they just might more naturally fit into all those buckets we just talked about where they make sense. Sorry.
Yeah. Yeah, I don't think anyone who gets a living revocable trust will regret it. That's not the issue, other than, like, the cost, what, $1,000 to $3,000 probably is the going rate, depending on the lawyer and whatever. And then there's the minor hassle of having to retitle your stuff, like actually change your bank account to be owned by the trust, change the title, the deed on your house to be owned by the trust. But once you get over that stuff, it's basically seamless. Like, it doesn't change your day-to-day life, and I don't think anyone's going to regret having a trust after they die, and their trustee/executor won't regret it. So I'm not against them. I'll never tell someone, no, absolutely don't get it. But I'm less convinced they should get it. And I almost feel like I might be missing something, and I'm waiting for that aha moment, again, outside of certain situations. So who knows? Maybe one day it does, the light hits me, but I don't know. But I like what you said, though. You raised a lot of good points, and the clients you work with may lend themselves naturally to have more benefits from trusts.
Right.
Yeah. All right.
One planning point before we move on. It's recently come up a few times for people who do have trusts. If you put your home and other things in it, to be talking to your insurance agents and stuff and see if your trust then also needs to be listed on those policies for the assets that then the trust owns. So talk to your state attorney and insurance if you are implementing these tools to make sure it's, like, fully executed.
That's a great point. And I think also if you own your home in your name and you have a mortgage on it in your name, I don't know if you can change the ownership of the house to the trust, because then would the trust need to be on the loan? You have to, like, redo the loan or something?
Maybe, like, I've seen it come up with insurance, not necessarily with the mortgage, but I do wonder if when because some of the attorneys that I work with will help the clients like retitle the home specifically. I wonder if that is part of the process. So I'm going to like take away and ask that.
Okay.
It's my own follow-up.
Let me know what we find out.
I will.
Another hot one, current events one, is the stock market. And if I were to do a Seinfeld impression, like, what's up with that? It just keeps going up. I'm not complaining. I mean, there was a nasty spell a few months ago with some current events and news and tariff talk, but now it's like S&P's back at an all-time high. International stock market's up like 18% for the year, and we're only halfway through the year. There's so many things I feel like that people could and should potentially have on their radars as like things to worry about or potential bad news, but like economy seems to be chugging along well enough. Stock market seems to be brushing off everything that happens, including bombing Iran. I would have thought that would have like really snarled the stock market run, but it's like, oh yeah, non-event. I don't know. I mean, I don't know where to go with this, but you have any thoughts or commentary on this?
I will tell you what the same conversation that I'm having with my clients. And like, I don't know. I do think that some of the valuations and the numbers continue to be surprising, and it does keep going up. But it seems to be a series of alternatives to me. So if you have money that you want to invest or put aside for the long term, like where else would you put it? And cash is paying a little, is definitely paying more than it has in past years, but the market still seems to be returning more than that over the long term. It seems to be doing better than bonds. It seems to be, so it's like, if you had this money, where else would you put it? And I think people are potentially looking around saying, I don't have a better alternative. So even though I think that this is high and expensive, I'm going to continue to put money in. And as new people put money in or money gets invested, it's driving that, it's pushing the boats up. Yeah. And I do think that there's segments of the market that are more expensive and have run up more than other segments. For a while, like you said, international's up 18% this year. That hasn't been the case in past years.
Right.
So I do think that there's certain segments that are more run up than others, but overall, that is all I've come up with, is that there are no better alternatives.
Yeah.
And that people do have the data at their, and people have more access through index funds and other things to be more passive investors. And so people are taking advantage of those opportunities. You got something different?
I don't. I've always said, though, like I know neither I nor anyone else, shy of people who do insider trading, which is illegal, can ever consistently and confidently say they know what's going to happen or by what extent for any given stock, any given sector, any given market as a whole. But the only thing I'm confident in saying about the stock market, be it the US or the rest of the world or combined globally, is that unless you assume the U.S. or global economies are going to stall out and or crash and never recover, there's no reason to think the stock market won't go up over the long term. Long term meaning at least 5+ years, if not 10+ years or more. But anything can happen super nasty along the way. Any given year, it can lose 20, 30, 40%, depending on the market, right? Or maybe over 2 years, 3 years, it's down. But again, long term, I'm comfortable in saying, barring sort of an economic collapse of the world, stock market will go up. And so even for people in retirement who are 60, 65, assuming they live average life expectancy of 85-ish, they still have 20+ years. Yep. So a portion of their money, like the stuff that's bucketed to long-term growth, could and should still be invested in stocks or other comparably sort of risky but long-term growth expected assets. So I just say, I never try to time, I never try to get people in and out of stocks based on a hunch. I make sure people's allocations are, I'm okay with it and they're okay with it, the level of risk they're taking, that they can sleep well, and it's enough long-term growth but not too much risk. And I don't let people's actual allocations deviate too much from the targets. Otherwise, everything else is noise. I know it's going to drop at some point. I know there's going to be unexplainable rallies that persist like now, and we just roll with it. When their stock allocations build up too much because the stock market keeps going up, we simply rebalance. We sell off some stocks, redeploy to bonds or cash or whatever, and just keep sort of using the target allocation as a forcing mechanism to not let stock exposure get too big or too small. And that's it. Otherwise, it's just, I don't use the word gambling, but it's just speculation, trying to guess what's happening and why, or when's the shoe going to drop or whatever.
I tell my clients that the asset allocation, like at the highest level, the mix between stocks and bonds is like the biggest, most important decision we make together, because you do have to be able to like ride it out through the good and the bad periods. And you can't, if you pick too aggressively because the market has been doing so well and it all feels good, when that big pullback comes, you have to be able to ride through that bump as well. So I agree with you, picking that asset allocation and rebalancing back to those targets is really important discipline of being a long-term investor, because I agree with everything else you said. Over the long term, it seems like the best bet, and everything else is noise because we don't know what'll happen tomorrow.
Yeah. And like we mentioned with international, I just want to say this. I've been saying and feeling for 15 years.
Yeah.
So ever since the global financial crisis of 08-09, the U.S. stock market has been on an absolute tear and has summarily trounced the returns of the rest of the world stock market. Whether or not that was overdone, like who knows? The U.S. stock market was largely driven by the big tech companies that just had this runaway stock price growth over the last decade and a half. But I've been saying for years, like, and defending why people should have some portion of their stocks in international, whether it's a third, a quarter, whatever. Because if and when the tides change and the U.S. isn't comparatively the stronger economic engine compared to the rest of the world, like, you'll be glad you have some non-U.S. stock exposure. And every year, it's like I had a lot of clients who like, I don't get it. Why do I have international stocks? I'm like, it's going to happen at some point. It's going to happen at some point. And finally this year it has. Now it's been 15 years. So it's like even a broken clock is right twice a day. I'm not saying I'm a genius, but it's like, okay, finally it's good to see globally stock markets sort of normalizing and this sort of normal ebb and flow of like the U.S. isn't always going to be the economic powerhouse, or at least comparatively, the outperformer compared to the rest of the world. And what we finally saw this year, I sort of feel like a little bit, I don't want to say vindicated, it's the wrong word, but it's like, I'm glad to see international finally do something good this year. Again, up 18% as of the recording of this, versus U.S. stock market's up a few percent.
Well, I've been having the same conversations. I also have held international and emerging market stocks for all of the same reasons that you're talking about. Same thing. You could argue the same thing even within the U.S. with the growth tech stocks and the more value-based stocks, right? Like, that it's important to hold all of those, because what is the current outperformer will not likely be the outperformer forever. But it can be tough conversations when it just goes on and on and on with the same thing, year over year. So I agree. It is, I agree with you. Maybe vindication isn't the right word, but like a nice reminder that like the top 10 large tech stocks may not always be the top performer in forever and ever and always and always.
Yeah, it's easy to get stuck in that. Is it recency bias? Is that the bias, I guess? Like, what's done well in the past, so I'm going to think that's going to continue to be what's going to do well or do better. Yeah. That's not the case. Or at least won't always be the case. It has consistently been the case for a while, but it's not always going to be the case. Any other stock market ruminations here before we got one final topic?
Those are the big ones. So I think we kind of covered it, and it seems like we kind of agree on the execution of. I guess I'm curious, what mix do you generally recommend to your clients between U.S. and international?
Great question. This is not investment advice for anyone listening. Nope. It's what I do personally and what I advocate for clients, but whatever the stock allocation is, whether it's 100% stocks if you're super young, or 60-40 or whatever. My default approach is 2/3 of the stock allocation is U.S., 1/3 is international. Within the 2/3 that's U.S., half is large cap, so like S&P 500. The other half is small or mid cap, and that's it. Now, some clients want slight massaging or tweaks. Like, I've had clients who pushed me to get them more S&P exposure comparatively. I've only had one client ever say, no, I want no international, period, and I did accommodate. We since parted ways. He voluntarily left, for not for bad reasons, but otherwise I do have other clients that push back on international and want it dialed back to like 20% of their stock exposure as opposed to a third. But I don't think I have anyone less than like 20% international. Everyone's been on board enough with my international story. How about what's your approach to it?
So it seems like we agree a lot. I also do the 2/3 US, 1/3 international. And then within the international, it's 2/3 developed country stocks and 1/3 emerging market stocks.
Okay.
Within the US segment, I have more of the like DFA Avantis approach where we're buying the market and tilting into certain sectors versus making a large split between growth or large cap and mid cap. But overall, our general advice is the same. I haven't had too many clients push back on it. I would say the biggest pushback I get internationally is what to do about Asia. But it's like very specific to people's how does that fit into the market without getting too deep, because it's categorized as an emerging market. It's underweighted in some of the benchmarks, and so it ends up being a conversation of like, do you put an overlay in to bring it up to match the like market cap? But that ends up being very client specific questions. So I agree, 2/3, 1/3, but definitely not advice for anyone who hasn't had a conversation, but just generally where I start my conversations.
And I'll add that this 2/3, 1/3 mix, and within the 2/3, like me splitting it half between large cap, half between small and mid, isn't super scientific. It's based loosely on, if you look at the global stock market and how much of it's US versus non-US. Last I looked, and this was like a year ago, it was like half, maybe 40% of the world's global market capitalization was non-US. Yep. So if you wanted to simply mimic how the globe is currently situated in terms of stock investing, you should have like 40% or half of your portfolio international. And I'm not saying people do that, but it's not unreasonable just based on that. So I was like, I don't know, I feel like 1/3 international feels good. You want to have enough that it matters. Like if you only have 5% international, what's the point? Like you're not really doing anything. So have enough that it matters, but also like, it's going to be a hard sell to convince US people that they should have half their portfolio in non-US stocks. Plus the US has done so well historically, whatever. I was like, I don't know, 1/3 feels good. So I'm very comfortable dialing that up or down as clients see fit, because admittedly it's not super scientific to start with, but I think it is based on some semblance of logic and rationale for why going with 1/3. I don't know if you've done more rigorous analytics than I have, and just being like, I don't know, this feels like the right percentage.
I mean, it started with the same analysis, right? Like if the world is generally 50-50 or something close to it, but we get paid in dollars, we live here, like, so it seems like there's a reasonable reason to have like a US bias, or more in your portfolio. And like you said, you need it to be significant enough that when the international stocks do outperform, that you're capturing and participating in that. And so my unscientific answer came to the same place as you, right. But it started from the same analysis. Is if the world is 50-50, what does that mean, and what should the portfolio look like?
Yeah. And there's no definitively right way to structure a portfolio. There's so many ways to do this, and I'm not saying anyone's research or approach or philosophies are necessarily wrong, necessarily right. I think as long as you're in the ballpark of diversified, low cost, easy and simple enough to understand and implement and whatever, that's fine enough. That's defensible. Like there's no guarantee that's going to do any better or worse than someone else's approach. Only time will tell. And at that point, hindsight's 20/20, of course. But what are you going to do going forward? There's no guarantee that what's done better in the past will repeat itself going forward, like we've already said. So.
Yeah.
All right. One final thing, not hot at the moment necessarily, but I think a constant sort of question or topic that comes up that I've seen with clients, and just concepts around like lifespan and how much of your lifespan and life expectancy is going to be healthy versus non, in terms of like how do you set expected death ages in your modeling and planning, or how do you model in like the chance of long-term care happening, what it's going to cost, when it's going to start, how long it's going to last. There's lots of guesstimates that go in here, but what's your sort of thoughts and approaches here?
So this is one of those like sort of constant questions in my practice, right? Is how long are we planning for? Especially if your plan is tighter, right? And you're trying to figure out realistically how much can I spend? And as planners, I don't know how you feel, but I feel like I have kind of like a two-sided challenge. I never want my clients to end up at the end of their life and feel like they've run out of money or can't continue, like when they have very few options. But I also feel like there's this risk of people underspending in these earlier, healthier years and not doing the things that they want to do and ending up with this larger pile of assets that they transferred to kids or other beneficiaries, and maybe that wasn't necessarily their intended plan. And so this becomes the question in the practice of like, how long should our plan be? So and I hear a lot of like, but I also want to make sure I'm enjoying my money. Like, what's that health span for actually spending the money? I tend to start with just, let's plan to age 100 for the baseline of clients who are entering retirements. If I have clients who are older as we start planning, I had one client who, she was very worried about running out of money. And so as she got older, I just kept tacking on years to prove to her she wasn't going to run out of money. At one point, I think our plan was up to like 110, and she would laugh and like, I'm never going to live that long. I'm like, I know, but I want you to like feel comfortable that you're not going to run out of money. And so sometimes the conversation, this is where I end up plugging in like long-term care conversations for people, in that, you know, if we're worried about that, maybe we need to be allocating some of our upfront budget to help potentially cover higher than expected care costs or medical costs as we age. And maybe we're not covering 100% of it, but, you know, back to that idea that it doesn't have to be an all or none conversation. But I always start at 100, and then based on the client's personal tolerance for, every once in a while I have someone come in who is like, no one in my family has lived past X, like, do not run my plan past X, and we start there. But I generally start at 100 and adjust based on their age and expected health. What do you do?
I use 95. Interesting you do 100. Obviously more conservative, which, you know, conservative is better than not. But we use 95 as a starting point for everyone. And then if there's known family longevity, or like all the parents are still alive at 93 years old or whatever, then we'll up it to 100. I don't think I've ever, maybe I went to 105 for someone just because she asked. But you're going beyond 100, like the chances of that happening, I don't know.
Yeah.
Something on, yeah. Or if someone has known major medical issues, or like you said, family history, no one's lived beyond 75, 80, then we'll drop it down to 90, 85, whatever. I think rarely do I go below 85, if ever, for anyone. That seems just like too dangerous to assume. So that's what we do. And then long-term care, this is a tough one. Most of the clients we work with can objectively self-fund, and so the default long-term care scenario we assume is, let's assume it happens when you're 80 or 85, we'll just sort of randomly pick one of those dates, assume it lasts for 3 years, and assume it's the present day equivalent of $10,000 a month or 120 a year, and we inflate that with 5% inflation, you know, every year going forward. Yeah. So by the time a 60 or 65-year-old hits this long-term care scenario, it's like $400,000 a year in future dollars.
Expensive, yeah.
Now, why 3 years? I don't know. Somewhere I read, I think like the average stay was 2 years or less, but what if it is longer? What worries me, and there's no fix around it, is like memory care, or someone who has like 10 years long-term care event, memory care event of really expensive, really hands-on care for a decade. Like you can't plan for that. And that's an extreme, granted, but it will happen to some people. You just simply can't address that. Even traditional long-term care insurance, you're going to get a pot of benefits that last 5, 6 years maybe. Like you're still on the hook for multiple years in that case. So I don't know. I think you plan for what's realistically, statistically, potentially within the realm of might happen, and the outliers, like, I almost want to say you can't plan for it, but like, what are you going to do realistically? You're going to not spend any money, squirrel it all away in case you have this 10-year long-term care event?
When I feel like in the long-term care events, yes, you're planning for the person who needs care, but you're also planning for the spouse or the partner who may still need to like live for assets. Like I almost feel like my concern is, even if we could cover the 120 today, is there anything left for the other person to buy groceries and continue to live in their house? So that, and you mentioned that the 100 is more conservative. I agree, it's more conservative. I tend to have slightly more conservative clients, but I also have found that emotionally what it does for people is, if there is years earlier where they need to or want to take an extra expense or have a bigger spending year, that it provides that comfort that like we could have these like small blips and it's still probably okay. And so it's been an interesting emotional planning tool to plan for longer, because most people don't, in my experience, think they're going to live to 100, but they like to know that they could.
Right, if they do, yeah.
Yeah.
But this whole thing, this whole retirement planning thing is an interesting process, because it's like this moving target. It's a failure to run out of money before you die, but there's no way to know when someone's going to die, how much you're going to need to spend every year. It's also a failure to die with $10 million, unless that was their goal. But like, it's a failure to die with too much, because that's life unlived. How do you thread that needle without knowing the future of mortality, morbidity, tax rates, inflation, general lifestyle prep, whatever? You don't. Like, it's this moving target. There's ways you can take out some of the risk and unknowns, but it's still always a moving target.
Well, and I think that's why it's so personal, like so specific to each client and like what scenario you end up creating. I also think it's as much art as it is science or math, right? Because there are so many unknowns. It's a little bit of how do we get as close to as we can to the ideal scenario with the changing rules, the unknown, the unknown life expectancies, and all of the unknowns that affect people. So I think that is why it feels hard, particularly to people who aren't trained in doing it, right? I think it is a challenging, it's a challenge.
And it's hard to explain to clients who don't know that. Like, we've since realized and come to the conclusion, like, a lot of this is educated guesswork that we just have to plan around as best as we could, control what we can, right? Cost, emotional behavior, poor decision making, simplicity, whatever, But for clients who aren't aware that this is what it is, like, it could be unnerving, for lack of a better word, to realize there is so much unknown about the next 30 years, but that's what you have us here for, to help you walk through that and make changes as necessary and manage and adapt accordingly. So, and
I think that's why planning it's more of a process. Like, I think sometimes it gets presented 100%. As just like one and done option. No. And I can't buy into that. Like, it really is something that's like a living, breathing, moving target to me.
Yeah.
It's just not that one document is like a guess, right?
It really is. Like, and I think, like, for people that want one-time plans, it could be a good, just let me know, am I even on the right track? Is what I'm thinking feasible? Is it in the ballpark of reasonable to expect this could potentially happen? Yes. But the real value is the ongoing planning, because it is this living, breathing, iterative process. Any plan will be wrong and outdated, more or less, like right after you print it out and give it to someone. Doesn't mean you shouldn't do it, but a lot of limitations around that. So,
yeah.
Okay. I think I just realized now, as we were talking, I said earlier that this is going to come out July 3rd, and in reference to the big, beautiful bill, and like, this could all change. This episode is actually coming out July 10th.
Okay.
So there's a really good chance by the time you all listening hear this, like, the big, beautiful bill will be out, and some of what Lauren and I said is already wrong. But we did the best we could. Awesome. A lot of fun here, Lauren. Anything else you want to share with folks? If nothing else, where can they find you, learn more about you?
They can find me at daybreak-wealth.com. They can also give me a call, 630-570-0611, if they really want to talk on the phone. Okay. But starting on the website is the best place to find me. But thank you for having me on. It's always fun to chat about the conversations that we're having with our clients, and to hear different planners' approaches to how we're solving the issues that are sort of unsolvable, right? The ever-moving, ever-changing.
Great way to put it, yeah. Trying to solve the unsolvable, yeah. All right,
thank you
awesome.
very much.
Lauren, thank you for being on. Greatly appreciate it. And thank you to everyone listening and watching.
Thanks.